Hello, everyone. Good afternoon, and thank you for joining us for our lunch and learn moment. We're having a little bit of, my video may pop on here in a minute here, a little bit of difficulty here is that we want to talk about uncharted waters. And our country's definitely going through uncharted waters with this pandemic and the ensuing economic crisis as it's unleashed. I thought we would look at what history has told us about the past. We maybe learn about previous pandemics and how they've affected the markets and the economy. We've found out there were 3 other pandemics in the last 100 years, not including this current COVID-19, and look at what our markets are doing and how the economies are reacting and what we might be able to expect for and hope for improvement, to become optimistic again. We are also might touch briefly on Social Security and interest rates as we kind of do a forward look ahead on effects of our government's deficits and debt that were unforeseen because of the COVID, and look at what to expect there and how it could shape income modeling in the future. But let's proceed, and thank you. So where are we now? Let's see what's happening in the S&P 500. I think, so here's a chart here of the S&P 500 in the last 4 or 5 years. And we can see that it's a very nice, smooth ride upward. And then here on February 20th or so, we hit a peak, a record, and we shortly thereafter encounter COVID-19 and a head-on collision with COVID-19. And in 17 days, we lose 33% of stock market value in the S&P 500. This was the fastest forming bear market in American financial history. Here we hit bottom on March 23rd, and on March 24th, Fed Chairman Jerome Powell announces that he will do whatever it takes to stimulate and help the American markets recover and the American economy, more importantly, recover. Not that markets are not important, but the broader economy is where we make our livings. And that he begins to unleash a series of programs, up to almost 26 different Fed Reserve Bank programs between lending and open bond purchases, or open market activities, they're called. And he's done this with such speed, it's really resuscitated the markets back. And we see what we've all sort of realized now is that we are back at a new record, which is in the S&P 500, a positive record, the positive high. The drivers for the rally have been big tech, so the Facebook, Apple, Netflix, Google. They're also called the Super 7, NVIDIA, and Tesla's in there too. And this graph shows, as of the end of July, here we are in March, I think it accents very well how big the tech rally has been compared to the market itself, which is right here, the index of 500 stocks. And then this here is the US Bank Index, which shows us that value stocks have not at all participated to the extent that large growth stocks have. So once again, growth stocks are substantially beating value stocks, as here. Let's take a step back and get a longer view on the S&P and the trend line growth. So here, this is the trend line growth from 1926 all the way to last week for the S&P 500. And you see, this is then the trend line movements for that same 94-year period. Here, the trend line dotted making a straight line through all the volatility, through all the decades, is growing at 2.8%. And these periods where the index or the market is above trend lines are here, here's the great crash of 29. But you see here we are now, and you can see we've been above trend even before COVID hit, several years before. This is part of the, what might be called the Obama-Trump bull market. And the trend volatility here, though, on the bottom chart is something I want us to look at too, for two reasons. One is this shows the over and under of the trend, and when the trend is in positive 30 here, as denoted by this line here, 25% of the time in the past, the S&P has had a negative 2% return the following year. That's 25% over the last, that's the past. Those are the statistics based on the past. Also, if the trend is negative, as you see here, a minus 30, this being 0, the S&P has had a positive 13% gain 18% of the time over the ensuing past history. So that trend, lets us kind of do a little test where we are based on the past. I'd like to mention this concave part of the chart here and this convex. These are some great, you almost think of them as beginnings and ends of waves or eras of capital formation based on interest rates, which we will look at deeper into the slide projection when we look at government debt, interest rates, and Social Security funding issues. But this convex here, here is the 60s, and here are the 80s, leading all the way up to the end of year 2000 right here. And so it's hard to tell, what type of wave we're in since 2000, the last 20 years. But we'll see, I guess. Time will tell. Back to the present, the cyclical growth sectors are gaining in August. So we ended the month of August with that rally in tech stocks, very, very strong rally, spreading to other sectors, including consumer discretionary, industrials, consumer staples, materials. So in a much broader rally among industrial sectors, not just technology, although technology continues to soar. Not every sector is in positive territory. Airlines, energy, tourism are still suffering well below where they were pre-COVID through the crisis. What's happening globally in GDP, and this is the driver of the economy. This is where what we really want to see, back to economic growth as soon as possible. So we just went through as a country our worst financial quarter economically in recorded history, the second quarter of this year, which ended on June 30th. And we contracted or shrunk by minus 9.5%. This was due, of course, to the shutdown of the economy to protect ourselves from the virus and give our scientists and medical professionals, time to deal with the pandemic. And so the shutdown was immense, as we've all living through it now. Wall Street was expecting a minus 10% contraction, and there were even those thinking it could be minus 12, minus 13. So good news, a little bit of good news, and we can take whatever good news we can get through this crisis. We didn't shrink. We shrunk a little less than minus 10 at minus 9. So this compares to what China did in the second quarter. They actually posted a gain of 3.2 in their second quarter. But keep in mind that they went through their COVID crucible in the first quarter of 2020 and shut their economy down stringently in January, February. They have since opened up to a large degree, and they posted a tremendous gain here in the second quarter of 54.6%. We're now in the middle of our second quarter post-COVID, and there is a lot of hope and rational thinking that we will see a plus 35% annualized gain. That equates to about 8.5% growth, which would be a very good step forward in digging out of this minus 9.5. This is part of the optimism that leads to these record highs in the stock market, is that we can get through this crisis economically. We're starting to see that, and it's because of Federal Reserve help and Congress taking unanimous action to pass the CARES Act. This has put money in the street through PPP loans, through enhanced unemployment, just aid to schools. I think just trillions of dollars into our economy. But that's why this has been called the better than expected rally, or the BTE rally in the S&P, it's been nicknamed. So if we momentarily take a glance, we'll leave this chart here, but you can see other sections of the world, European countries not faring as well, Euro area minus 15 on their second quarter contraction, and England or Britain minus 21, just noteworthy. Let's go back into the past for a moment and talk about the three pandemics that we've gone through. The first and probably the most notorious and deadly was the Spanish flu, but we also went through a pandemic in 1957, which killed over 100,000 Americans. And we also then went through one in 68 and 69, which also killed over 100,000 of our citizens and millions of people, or at least a million, around the world in the late 60s and 68, 69. But let's look at how the markets did in these three different pandemics. So this is the great influenza that came with the Great War, and this is the S&P. And enlarge that for you, but here's where the war ends here. The flu starts here and then goes all the way to the early 1920, and you do see some pretty big market drops here. The market was much smaller back then if you look at its valuation, but still some drops and some volatility here and going down, and then of course it gives way to the Great Roaring '20s. So we see that the Americans put it behind us and went on to new heights to 1929. So wherever the Spanish flu leaves the scene, and it goes wherever viruses go when they're not killing us, and it reemerges though, the Spanish flu, in some sort of mutant variation in 1957 with the Asian flu, which hits us in 1957 and kills over 100,000 Americans at that point. We kind of go through that period. Of course, there are other factors in the economy and the world at that time besides the pandemic, but we do emerge from it and move on to new heights in the market and the economy by 1960. Then 10 years later almost, H3N2 comes back and starts circulating it. This time it's named after a city and not just a continent, Hong Kong flu. And it hits us in 1968. September of '68, which we had a lot of things going on in our country in 1968, and a lot of it wasn't good politically. So it was just before a very divisive election during the Vietnam War era. We're hit with this pandemic, and we seem to just move through it all the way to 1969. We have a trivia question as a sort of a door prize on the honor system. August 15th, 1969. If you know what started on that date, let us know and we'll give you your door prize. That was the day that Woodstock started in the summer of '69, and that was certainly a super spreader if there ever was one. And but we did manage to have giant rock concerts and elections, and went on to put a man on the moon. And throughout, we do get through this and move into the '70s, where we hit a high again in '72. So this is why we have optimism that we can get through the pandemic eventually and in the right way. What's driving optimism today is the hunt for a vaccine with Operation Warp Speed. And as of August, and these numbers were taken from August, I think investors are looking at what's out there for the chance of a vaccine, and we see there's 135 vaccines currently under development. I believe there are 90 different government labs around the world funded, hopefully to the hilt, plus private institutions. There are 20 vaccines candidates currently in phase 1, 13 in phase 2, 9 in phase 3. There are actually 2 vaccines in use today. One is by the Chinese military for their military personnel. The other was, and some of you may have caught this in the news, the Russians have one that they are using. I think eventually we'll have ours here, of course. Dr. Fauci believes that sometime soon there'll be a series of vaccines. So this is what's giving stock market investors confidence and optimism that this thing, will be beaten back, this COVID-19. And this optimism continues to show up in other charts, other stats in our business. This is the mutual fund manager's percent of their funds in cash. So if a money manager is reluctant about investing, she may keep 10%, 8% of her assets under management, and I'm speaking about funds like Fidelity Magellan and Vanguard Wellesley and American Funds, Growth Fund of America, these very large custodians of Americans' assets. And when they're making their investment decisions, if they are fully invested and have very little in cash, that means they're very optimistic. They say they're invested fully in their best ideas, as they like to say. That's, whether rightly or wrongly, that's these ideas work or not. It is a sign of optimism in the money management business. Don't fight the Fed. That is the old adage on Wall Street. If the Federal Reserve wants interest rates to go up, it will have interest rates go up. If the Federal Reserve wants interest rates to go down, it will go down. I've always liked this quote from James Carville. I used to think, and he says this, and I'll just read this. I used to think that if there was reincarnation, I wanted to come back as the president or the Pope or as a 400 baseball hitter. But now I would like to come back as the bond market. You can intimidate anybody. I think what James Carville, Bill Clinton's political advisor, was saying back in the 90s, early 90s, when he said that, was the bankers call the shots, and when it comes to economic decisions, and they have for a very long time, and they This chart on chart 3 shows banker Jerome Powell of the Federal Reserve Bank has used this power to put trillions of dollars into our economy and into our markets. This shows the balance sheet of the Fed pre-COVID, the calm months before COVID, and when COVID hits, you see the balance sheet moved almost $7 trillion. That represents loans to American firms. That represents bond buying in the open market and holding those bonds, mortgages, credit facilities, all are encompassed in that $3 trillion that Chairman Powell and the bank have put into our market, which puts a lot of money coupled with the $2 trillion CARES Act in our system, looking for places to invest. The second driver that the Fed uses is just ratchet down interest rates to extreme lows. We've all seen that. Mortgages on the 30-year mark are 3% or less. This helps American families buy houses. It helps American corporations refinance their bonds. There's been a record bond issuance by corporate America since COVID, and it's to take advantage of these record low interest rates. And this is one of the things that we want to think about, and why we're going to bring in Social Security here at the end briefly, is we're thinking about these things for client portfolios, these things meaning these forces, these era-ending events, if you will, and how to derive income for the average American family in markets that are being shaped by these forces. There's no easy answers yet, and everything is still in flux and subject to change. But as we look down the road, these are essential thoughts that we have to have. Let's look to the past again and look at interest rate history since 1966 to the present. This time encompasses two periods: the Great Inflation period of the late 70s, mid 70s, and then the Great Moderation or the Great Deflation of the last 40 years. So the shock, our country had a lot of shocks in the 70s: the oil embargo, rise of globalization, the beginnings of offshoring were occurring. Asia was reemerging from the carnage of World War II, so they were more competitive on the global scene with car manufacturing, steel, and electronics. And that period of time was here. We saw inflation get out of control in the late 70s, and Fed Chairman Paul Volcker had to take severe action by increasing interest rates upwards to 14 or 15% here in the 78 to 81 period. Inflation was eventually tamed. It was a severe economic shock to our country at that time, but the ensuing 40 years saw a very steady decline in interest rates, and this led to a steady increase in the stock market. Well, you can see we're coming to about as low as you can go on interest rates, and they can stay here low for several years, but there are forces in the future that we just have not, we don't know how they'll affect us. One of those forces is the unprecedented debt our country has incurred, both household-wise, corporation-wise, municipalities, and on the federal government level. This chart here, twofold, shows our government spending as a percent of GDP. And you can see there's ups and downs over the years dating back to the end of World War II. The blue chart shows tax rates as a taxation as a percent of our economy since World War II. And the red shows deficits of our federal government. And you can see we're pretty good at running deficits over the last many years since World War II. We do have a few times at the end of the Clinton era when we were at a budget surplus, so we can do that. But right here, we see a big bulge or a big surge in the deficit, which is going to, this year be almost $4.5 trillion. And you see us borrowing this money here, and then we're turning around and pushing it back into the economy. You see a similar surge as getting that money via government into the economy. And this has been, to protect ourselves from the ravages of the shutdown because of the virus, protect ourselves economically. Nonetheless, we still go into this COVID crisis carrying a lot of debt and future obligations on our federal level. And this chart shows, what we expect this year's deficit to be. The red indicates COVID-related costs and how we're going to amortize them out over the next 10 years. The blue is what I wanted to mention and bring in Social Security briefly before we end, and talk about we already were obligated pre-COVID to some serious deficits that we needed to get a handle on to keep our social programs such as Medicare and Social Security solvent for the next 40 years. But it's not the first time we've had to face those solvency issues, and we'll look at that here in a minute. But this chart does show deficits ahead until 2030. Taking a step back into history again, bringing up the obligations of Social Security and Medicare, but mostly you look at just Social Security here, is Jimmy Carter had to deal with a Social Security solvency issue brought on in part because of the great inflation of the late 70s. And President Carter had to pass it into law in December 21st of 1977, a payroll tax. Some of you may remember that. It was unpopular. It was very necessary, unfortunately, and it was also costly to the economy, which was vulnerable at that point due to stagflation. So it was not the good time to have a payroll tax increase. However, what had happened is in the late 70s, with the inflation running at 9 to 12% a year, a Social Security pensioner collecting $500 a month and living on that in the early 70s was finding that she was losing her buying power, at a terrible speed. So by the end of the decade, 1977, 78, Social Security recipients were just not able to make ends meet, and that tax had to occur. What we're looking at here now, kind of once we get through COVID, not right now, but we're going to have to address Social Security reforms in a reasonable and effective way again, like we did in 1977. This chart shows the percent of our population, moving into their over age 65, and this is no surprise, as the baby boomers were, one of the largest groups generationally in our country's history, the post-war baby boomers. And we can see, here, in not too distant future, we're going to have 1 out of 5 Americans, or 20%, over age 65. So that will be a lot of people that will need Social Security. And the drawdown for that has already been shown to us by the Congressional Budget Office and actuaries for the trust fund. And this chart, looking ahead, is showing right here drawdowns, and this is about where we are now, and this was all sort of pre-COVID. This is going to occur whether COVID happened or not. And you can see we're drawing down from the trust fund, and in 10 years or so, we need to come up with a new action plan. So this affects how Americans are going to retire. This affects certainly the younger people who have to pay the payroll tax. It will affect how retirement in the future looks for someone retiring in 2030 or 2045. And so these are some of the things we want to continue to think about. There's no easy answer right now, but that is about it on slides. I do have one other slide, and then and it's this. My advice to everyone is, once you study the alleyways of our national debt and look down the future at Social Security and look at charts, you want to end by looking at something a little more uplifting, like pictures of kittens and puppies. So I wanted to let you have a moment and digest that kitten and puppy picture. But no, seriously, I want to thank you, everyone here, Brett, Leslie, Leanne, Parker. We all want to thank you for your confidence in us during this crisis. We wanted to assure you we will continue to work diligently on these matters for you. And we look forward to seeing you. And we also wish the very best for your families, health-wise and economically, through this. And I think if there are any questions now, they might come by email, or we can follow up later individually. But stay healthy.